Sir, are you suggesting that I do defective work?
Well, I guess only intentionally defective.
DJ Q-Tip over here is defective. Mr. Simply Tax Guy, do you want to do your explaining thing now?
An intentionally defective grantor trust, or IDGIT, is an irrevocable trust where all income earned by the trust is taxed to the grantor because the trust is defective for income tax purposes, thus allowing for a tax-free gift to the trust beneficiaries. However, transfers to the trust are complete for transfer tax purposes. This strategy often involves the sale of a highly appreciated asset by the grantor to the irrevocable grantor trust in exchange for an installment note. It's important to note that the trust must have sufficient assets so that an installment note would be considered commercially reasonable, and this is typically accomplished by gifting seed money to the IDGIT. So, to the extent that the growth rate on the assets sold to the irrevocable grantor trust is greater than the interest rate on the installment note taken back by the grantor, the excess is passed on to the trust beneficiaries free of any gift, estate, and GST tax. Tax on the trust income is paid by the grantor, which further removes assets from the taxable estate, and the trust beneficiaries ultimately receive the trust property income tax-free. In addition to being defective, irrevocable grantor trusts are complex, but Steve Gorin did a great job of breaking them down and explaining the nuances in episode 51 and 52 of the Simply Tax podcast. Subscribe on iTunes or wherever you get your podcasts and give it a listen.